Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
I want to appreciate for those of you new to the show, oh gosh, we've been doing this 20 years or so. Been on the radio probably 25. And I remember I started a career on the radio talking about hidden fees in mutual funds. I, at the time, sold a lot of mutual funds. I like mutual funds. I just wanted to make sure I wasn't paying twice what somebody else was paying. For the exact same thing. I want to make sure there was not overlap between the funds.
In fairness, it seems like there's a lot of hidden fees in everything we do in life.
Yeah.
You want to know what you're getting into.
And then it's evolved to every other thing. And now the advent of, ETFs, exchange-traded funds, all those different things have lowered fees a lot. Boy, when I got in this business, the fees were probably 10 times what they are now.
Oh, yeah. And remember they had wrap accounts?
Oh, yeah.
You'd pay all your normal fees, and then they would manage those for you and wrap it with another fee.
Oh, yeah. So the world has changed a lot, much better for the consumer now. Don't get me wrong. You still have those scams with, some of the private investments and everything. But I'm talking about the legitimate registered investments. The fees on this stuff, I hand that to Vanguard. Bogle, he's the one that said, hey, I can do this for cheaper. And that caused the entire industry to do it. Right now, the normal, back then they called them stockbrokers. There was no such thing as financial advisors. Everybody was a stockbroker, commodity broker, whatever. And right now the fees are 1/10 of what they were when I got in this business 30 years ago. 1/10.
Before we get into this financial quicksand with markets and all of that stuff and quantitative easing and quantitative tightening, what do you think about the market? We had our first month in February in forever.
That's right.
That was a down month. I heard Thursday morning on the way into the office that General Motors, not quite 7%, 6.7, 6.8% down in sales. Ford was down almost exactly the same. What is it now? Fiat Chrysler. It was Daimler Chrysler. They're always changing.
Right.
Fiat Chrysler was down over 14%, 14 something in sales. So,
is it the start? Is it a blip in the radar, or is it the start of a bear market?
Well, I heard people talking about 30% decline. They said, "Well, when's that going to happen?" And the girl was pretty sharp. She goes, "Well, I've always been told never predict the trend and the timeline. You got to do one or the other." But the point is, the economy is strong. We talked about that on our market panic show, right? How strong everything really looks. Consumers have more money in their 401ks and in their stock accounts. Their paychecks are going up. More of them are employed. They got a little tax relief, crumbs as some would say, but they got some tax relief. So there's more money in their pockets, but the numbers aren't showing that they're spending it. What do you think?
Well, a lot of times the market just went up too long. It just went up too long. It never go. This is the longest bull market in history. It never goes up that long without some kind of correction. A correction's healthy. You're talking about 9 years in a row, which there's never been a 9 or a 10. So right. That's a long time. And so when you got the forward-looking PE ratio like 28 when it's normally 14.
Times earnings.
The Shiller PE ratio is 30 when it's normally 15. And think about that. You would not buy a private company and it took you 30 years to get your money back.
Not a good investment, is it?
It's terrible, right? But that's exactly what we're paying for stocks right now. But what did they have a choice? CDs are paying 1%, right?
There was no competition for the dollar.
So I kept it up longer. That still doesn't mean everything doesn't go back to a mean at some point. They always do. I was telling somebody, do you know when it's going down? I go, I don't know when it's going down. I'd be a trillionaire if I knew when something's going down.
There's a thing called options.
All I know is every time it's reached this level, it's gone down. Because if it dropped maybe 30% right now, you get your valuations closer to in line to where they should be. They're still going to be a little high, believe it or not, but they would still be closer. Now, you can run for a few years with numbers out of whack. We did that in the late 90s, in the mid-2000s. Ran for a couple of years out of whack there, but it doesn't last long. We've been out of whack now for 4 or 5 years?
That's right.
The valuations have been, I think probably 4 or 5 years, the valuations have been higher. Even though earnings are increasing, which makes the PE ratio, price to earnings, thing, but the price is going up with it. And so that's why your values keep getting higher. I have no idea if this is the beginning of a bear market. All I know is you need to be prepared for either way.
That's all we talk about. If you have your buckets in order, which is a continuation of last week's show, then it really doesn't matter. It should give you peace of mind. It should give you some ease. We talk about the psychology of investing all the time. And if you're at ease and if you're not on the edge, going up and down with the market all the time, it makes it a lot easier, a lot clearer. The visibility is good. You can make the right decisions. Some of the things that you're going to be hearing about coming up will be quantitative tightening. They refer to it as QT, to use the acronym. We went through 3 stages of quantitative easing, if you recall. We had QE, the acronym 1. We had QE2. And then the third phase, through December of 12, was Operation Twist. And
they call that QE3 too, I think. So.
Yeah, either or was analogous almost to it. But you're going to hear it a lot. So what does that mean? Well, we thought maybe the easiest way for those that weren't familiar, and you don't do it every day, so we understand that, is kind of go through quantitative easing a little bit. And as we talk about all the benefits of quantitative easing, just think of the opposite or the reverse when they do the tightening. What quantitative easing was a massive expansion of open money operations. It made it easier for business. That was the purpose, was to stimulate business, and banks were adding to their liquidity, and it increased the money supply. So where does the Fed get the money or the credit to do this, to make these treasury purchases?
Yeah.
They
print it.
They print it. Hence, you've heard the term, we're just printing money, the Fed's printing money. Well, that's what they did. They printed it, they created out of thin air. They print the money. They buy the securities. And they do that to lower interest rates and spur growth. The lower interest rates allow the banks to make more loans, which in turn is supposed to help small businesses.
Remember, when it's just the opposite with like bonds. You buy a bunch of bonds, you create the demand.
That's right.
Yields go down because if they'll buy them at 3%, they don't want as many at 2%. The other thing.
That's
so
right.
That's what happens.
That's right.
So it keeps interest rates low because we're a consumer society. What is it? 80-90% of our thing is what we spend.
Absolutely.
And when people have their house goes up in value, all right. When interest rates are low and they can purchase things, it makes them psychologically feel, hey, things are good, I'm going to spend more.
That's right.
And it does work.
It did work. And some of the other things, intended consequences, I would say, is it kept the value of our currency low. You've heard us talk about that a little bit. You heard our secretary talk about that of the Treasury. And when our currency is low, what that does is it makes our stock market, and I guess property as well, but it makes our stock market more attractive to foreign investors. Why? Because they get more bang for their dollar is worth more as ours goes lower. So think about it as I go through these. What I'd like for you to think about is what happens in reverse. Because the Fed's balance sheet went from $2.1 trillion to $4.5 trillion. And that has to be
fake dollars that they printed.
That's right, for the treasuries that they have. So, keep that in mind. So now we're talking about, and I can make it real simple on quantitative tightening, and I'll just quote a line here and how it's going to affect us. It says the Fed wants to start shrinking its balance sheet, getting rid of that $4.5 trillion, by letting the bonds, right, they've purchased bonds with the money they printed, by letting the bonds mature. So they mature, they receive the cash, and they don't reinvest it. It doesn't go into the market. So that shrinks the money supply. It strengthens the dollar, which foreign investors now don't get as much bang for their mileage for their dollar as they did when we had a weaker dollar. So all of that stuff is reversed. So all they have to do, if you think it's going to be something where $2.5 trillion is just going to flood into the market or something, that's not the case. When they unwind it again, they're just going to let these bonds mature. As they mature, they receive the cash, as Victor said, aptly, that they printed, and they're not going to reinvest it. So everything we talked about shrinks. Is that going to send the market in a tizzy? Probably not, but it's not going to help. I mean, if nothing else, it's going to put brakes on things. and some might argue brakes are needed.
Well, the one thing is, now we're saying all this with the quantitative easing and the quantitative tightening, but what is that? How is it going to affect? It's not. We're not talking about interest rates back up to 1979 levels.
I don't think they'll let it happen. Do
No,
you?
no. They're talking about a target of what, 4?
Yeah.
On the 10-year Treasury,
on the
which
10
right now is about 3.
That's right.
So maybe another 1% up. And that'll cause CD rates to go up, bond rates, fixed annuity rates, stuff like that will go up.
Competition with the stock market, as you talked about earlier,
and so
for that dollar.
And that's why, so some of your stuff, the market may go down, interest rates in your house may go up, it'll be harder to sell a house. Because when people are buying houses, 99% of the public, they're not buying a price.
No,
they're buying a payment.
That's right.
And I remember when I sold my VA loan years ago.
Was it assumable?
Oh, yeah, 8.5%, sold in like hours each time because they said they'll never have an 8.5% loan again.
Well, they had assumable loans. People didn't even have to qualify. You just signed up and it was yours.
Yeah. Well, that's, those kind of, we're not getting back to those days. They've learned their lesson from the early 80s. Don't let interest rates go crazy. Because even though the reason why they're going to quantitative tightening, you got to slow down an overheating economy. You need to slow it down because otherwise inflation just goes crazy. In other words, there's more demand for stuff. Everybody feels rich, right? They're all buying more stuff. Well, they can raise their price now. All the retailers raise their price because we can get more for it. That causes inflation all the way across. We already have medical inflation, health insurance, stuff like that.
We're getting some now.
So we have some of that stuff. But what does all that mean to everybody? Well, interest rates could go up. Your stock market might have a correction, or it'll, in the very least, be really volatile.
But set yourself up so you're comfortable through the transition, no matter what it is, because it'll come back up again. Oh, yeah. You can't get euphoric when it goes up and suicidal when it goes down. Right. Have a level playing field.
That's why I can't stand when I listen to radio shows. You're either a one camp or the other on a radio show. They're either the annuity guys, annuity's the greatest thing in the world, or the stock guys. Annuity's the devil's work, right?
Right.
Neither one are right. Because there's nothing that's beaten inflation long term more than the stock market. Nothing. I don't care if you got the best piece of California real estate you ever had in your life. It is not even close.
Ibbotson showed that on his charts, didn't he?
It's crazy. But should you have all your money when you're 70 years old? No, unless you're really risk tolerant.
No matter how good the market is, you shouldn't have all your money in the market. No.
So, and if you got your bills paid, remember we always say that. Well, that was the last part of our the last show. We were talking about
the 3 buckets.
The 3 buckets. The 1 bucket's your cash bucket or your emergency bucket. Even though interest rates are paying nothing, you want to, like money markets, stuff like that.
But you do that first.
That's right. 1 year and below. Remember, it's 3 to 6 months when you're younger worth of expenses in cash, and it moves to 1 to 2 years in expenses in cash as you become closer to retirement age. So depending on where you're at in that gauge, you should be somewhere in between there. I know interest rates aren't paying anything. That's not the purpose of it. Keep it in something a year and less, okay? Like a year CD or a money market, something like that. Then you've got the income bucket. Income bucket is going to bridge the gap between your Social Security, pensions, and what your actual bills are. Some people will go just hard expenses, get that guaranteed. Some people go all the expenses. I got a lot of people go all the expenses and another $1,000 a month.
Sure.
Because sometimes people say in the old days, they used to say people spend about 80%, 70 to 80% of pre-retirement expenses in retirement.
I think it's 100 now,
it's
don't
100 or 120.
Well, yeah.
Because what happens is they have more time to spend.
Oh, yeah.
And we talked about this before. During the week, I'm not on Amazon, anything. On the weekend, I'm like, hey, I think I need this new holster here. Whatever.
Even if you're not frivolous, you have more time to help the grandkids, to help your kids. And we all know kids and grandkids always need help.
Right. Or you pick up a hobby.
That's
right. I got a lot of retirees in my neighborhood. They start playing golf. They want to play poker all the time. Because they got more time now.
Oh, yeah.
They can't wait for everybody else to get off work so they can play with them,
Yeah.
But, so plan for a long life. So that's why you have to have guaranteed income sources only in that income bucket. You can have bonds. Bonds work perfectly. They're just not paying much now. The ones you can't have, or shouldn't have really, dividend-paying stocks, preferred stock
not
dividends.
Guaranteed.
They're not guaranteed. They can go down in a minute, and you can't tell the bill collector, I can't pay it now. The market's down, or my dividend provider didn't doing dividends anymore.
They cut my dividends.
Yeah, they cut my dividends, so I can't pay your electric
bill. Can you cut my bill in half, please?
Right. Or could you wait because the market's going to come back in about 2 months?
That's right.
Can't do all that. So what is the last bucket? The last bucket is your inflation bucket. also called the growth bucket. Because no matter what happens, you know the price of your water bill is not going down over the next 10 years. You know the groceries aren't going down. I've used this example before. I used to go to get a chicken for my mom and my grandmother. We used to go get chicken. He said, don't get up that fancy cut-up chicken. That cut-up chicken's like $2.
Get the whole chicken.
Get the whole chicken. It was like 50 cents. I know that's when everybody, it's like, remember your parents start talking these old stories? You're like, whatever, Grandpa. That's, I guarantee you.
No, we have the stories.
I get
That's right. Oh, yeah.
Younger people are going, oh, God, whatever. 50 cents, you walked in the snow 10 miles from school. Yeah, whatever. Barefoot. But it was. Now a cut-up chicken is like $15, $20. And that's just going to, even as a young person, when my family was young, my first child was born 32 years ago. And then it was, we would factor $50 to $100 a week in groceries, and we thought that was a whole lot. It's not even close now. Not even close.
You know the story with the old-timer coming home from the grocery store and looks at his wife and says, honey, you know what? Old age is doing me well. I'm stronger than I've ever been. Used to be I could only carry $20 worth of groceries. Now I can carry 100.
Yeah, so all that stuff you got to account for, and nothing is beaten market. The only problem with your market piece right now is what we talked about earlier. You've got a lot of the market's overvalued. It's double valued. It's starting to get volatile. We lost 3.5% in February. First loss in
and familiarity. If I can interject, the inflation bucket, the market bucket, is one that you're probably the most familiar with and the most excited to do. Why? Right. Because as you were younger, almost all of your money was probably there through a 401k because you had kids and you had to buying the houses and the cars and you were doing all that stuff. And it was exciting. You saw it go up and you saw it go down and you got familiar with the mutual funds in your 401k and you're familiar with that one. The liquidity, you didn't earn anything. You didn't want to necessarily do that. You're way too young to think about retirement. Right. So you don't, most of us, we should, but we don't think about the income bucket when we're young right. and can really make a dent in it. Right. But the inflation budget's probably the one that you're most familiar with.
That's right. And I think the biggest danger with people, retirement planning, financial planning, overconfidence.
Sure.
Especially if you've done well in the market. Like everybody made 20% last year just about, right? And overconfidence. I've had people that I've got 95% of my retirement in my company stock. Nice. It's always made better. You don't understand.
I've seen it.
You know how many times I've heard this over 30 years?
Can I say Ford or American Airlines?
TI was a big one around here. Oh, my gosh, we're going to... And, every down year, by the way, if you got all your money in the market, will delay your retirement at least 5.
Exxon. Not Exxon.
So if you're planning on retiring the next year or two,
Enron.
You're 100% stocks, and it does go down 30, 40%. Just say that you're not going to retire for another 4 or 5 years for each down year.
Same thing if that stock bucket's in your income bucket and you're withdrawing and the market goes down. It doesn't work.
You cannot take money out of a decreasing asset because mathematically you can never recover. You just can't recover, trust me. Because I got people all the time, well, the market's made 10, I'm going to take out 8 and make money every year. I go, it doesn't work. One down year, one big down year, you're done. It's impossible to recover.
You're done. That's right.
So that's why we got a managed program right now. We manage at Fidelity, but it's specifically designed to keep going. I don't know when the market's going to turn, but it has made so much lately. I kind of like to stay in it for my inflation or growth piece. So you stay in it, but if any sector goes below its moving average, automatically pulls you out of that sector. So even though there's no guarantees in the stocks, anybody tells you they are is a liar. At least it's specifically designed to ride the market. When it turns, it takes you out. I think the worst it ever had is like a 7% down year, which is not bad. The market's lost 50%.
For the worst year,
times,
that's right.
Yeah, so that's what you have. At least you have a protection feature on your stock piece.
While having the inflation.
That's right. And so even if I was one of those people that say, like I said, the more successful people are and the more time they have, even though their scope of knowledge is pretty narrow, they know their own financial plan, right? They know themselves and what they've experienced. There's so much ore that you don't know that you don't know.
Yeah.
Right? There's so many distribution strategies. You could be the greatest accumulator in the world of wealth. You mess up 1 year in the distribution phase, it's over. You're going back to work or eating cat food when you're 80. That's a problem. But overconfidence is the one thing I see. And the people that have the most time seem to be the most overconfident. For some reason, there's some jobs, I'm not going to mention who it is, but certain jobs where you're working like a week on, a week off, these ones always know everything. I had a surgeon one time, and I have a lot of doctor clients.
Sure, we both do.
But I had a surgeon, and they started saying, well, you don't understand. I already know this stuff. How, I go, I don't know. I've got 30 years of doing just this and the college to do it. Maybe medical school taught you 4 or 5 years of finance. No, but my experience did. I go, I get it. I go, but you got to make sure. You got to think about things you don't know can occur. And when you have 1,000 different things that you've experienced, you just got a perception. I mean, I can't. My brain just went dead. But you're looking at things from a much broader perspective.
Yeah, you can't see the forest for the trees, sort of thing.
So make sure you don't get overconfident. I've had people tell me this. I think that's a great idea. Makes all the sense in the world. But the market's not going down till August, so I'm not doing anything to August. And I'm like, oh. I don't know. I have no idea when the market's going down. But think about it is if you're trying to get that last piece, that's the people that get burned. In the 90s, most people had like 80% tech stocks. They dropped, 70%?
It was brutal.
But they didn't start with 80% tech stocks. They refused to reallocate every year. And what happened is they might have started with 20% tech stocks. But the tech stocks are making 50% a year, and your other stuff's making 10 or 5. It's going to become your largest allocation, and you're like, well, I understand technology. I'm a computer guy, whatever. And that's where I remember people telling me in 1999. They said, Victor, I know you sound like you know some stuff, maybe some IRAs, but do you think there's going to be more computers next year than here? I go, absolutely. Well, then, enough said. I go, that has nothing to do with it. I go, Yahoo is worth 7 times General Motors, and they had 0 assets. I go, it's just a bubble.
It's a real good example of where we are now. We've talked about it. Unemployment is down. Wages are going up. The economy is strong, but yet we still have a bubble there. There's air coming out, and stocks this week aren't faring well. It's not because things are crappy. Right. Things are good.
See, we don't say anybody shouldn't be in the stock market, in an annuity, in a money market, in a CD. You should be in all those things, depending on your situation.
Yeah.
Right? But if you've got the stock market right now, just think about it. It's gone up 9 years in a row. There's never been a 9-year in history. There's never been a 10. Will it correct itself? Maybe. This year's already showing us more volatility than we've had in a long time because all the news that's come out in the 2 months we've had of this year has been positive. Very good. What was the unemployment rate? 4, which is virtually 0, right? Because some people won't work no matter what, right?
That's right.
So we got 0 unemployment basically. We got rising wages. People feel more confident. Housing market's still going, right? Except if you look on Zillow now, look at it again, they've probably gone down some. If you haven't noticed it.
Mine is. I don't know about yours.
Mine did too.
Thanks for reminding me about that, Victor.
But they're starting to do it. I've got friends of mine that own construction companies. A lot less bids right now.
Yeah.
A lot less things going. I'm like,
and what happens when rates go up on construction?
It makes it worse, right?
It's tighter, rates tightens.
Well, think about it. I mean, what they do is they always overdo everything, especially real estate, right? In the 80s, the commercial apartment market in Dallas was decimated, right? I remember trying to look at houses over in Plano, but I thought it was too far north. It's Lost Legacy.
Oh,
now
yeah,
that's
about
mid-cities now, right? But I was like, they were giving them away for these 5,000 square foot houses they just built because the builder wanted to get out for $100,000. You know, I was like, wow.
That's crazy, right?
Well, I didn't do it because I was thinking they were going to go down further.
It's too far north. It's too far north. When they talk about diversification, what we would like for you to take away from all of this information is diversification within your stocks, right? Within your inflation hedge. Diversification as far as having those and having the income bucket and having the liquidity. Diversification isn't myopic. It isn't just I need to have my stocks diversified.
Right.
And in having that diversification, I'm okay because I've got a little bit of everything. No, you need to do that, but you need to do it in that bucket. Now, what happens if that bucket grows too big, which it has lately? You need to re-diversify. You take some of that out. You take care of your income. You have more liquidity. It's a constant fluid practice, and that's where we come in to help because we can take a lot of the psychological angst out of it because we're not emotional.
And here's one of the things that professional managed money does. We're fee-based, by the way. We only make more money if you make more money. If you lose money, we lose money. It's just by fee base. That's where registered investment advisor means we're a legal fiduciary. We have to put your interests ahead of ours. But with stocks, it's weird. I've been doing this for 30 years, and I have people all the time going, I'm very diversified. And you'll look at it, and they just have like 4 or 5 large cap mutual funds. That's it. Large cap. I go,
but they're all large cap.
Yeah. I go, do you realize every one of these has these 5 stocks in it? And some of these, there's like 20. You got overlap in each one. This one fund over here, you're paying 5 times the fees for the same stocks, about 80% of the same stocks called overlap in this one. And I go, diversification doesn't mean just a whole lot of companies. Because I got people all the time. I bought the S&P 500. I love the S&P, personally, by the way, I love the S&P 500.
Great benchmark.
Right? But they said, I own the S&P 500. How can it be more diversified than that? 500 stocks. Problem is, they're all U.S. large cap companies. And they're more of the stable kind instead of the growth. So you're missing out on mid cap, small cap, international. And then you've got subsets of each one of those. And then also, what kind of fixed income do you have? Well, they didn't want to buy, let's say it's in a 401k. They had like 3 bond fund choices. Well, you don't want to buy the ones making 1%, right? How about the one making 4%? Well, 4 seems pretty good for a bond fund right now, but problem is, it's all high yield bonds.
Let's connect the dots. We talked about quantitative tightening, and we talked about the easing. The easing, right, when our dollar is low, attracts foreign investors. Well, in reverse, with the tightening, and our dollar gets stronger, where would we get the most bang for our buck? Buying foreign stocks. If you have the S&P, you miss that opportunity. That's why diversification handles the things, as Victor said earlier, you don't know that you don't know.
Right. And when I'm talking about foreign stocks, I'm not talking about, like I said, a bank down in Paraguay or whatever. We're talking about like Mercedes-Benz, Toyota. Those are foreign companies that are really big and make a big difference. So make sure there's got to be diverse. That's why I like managed programs, especially for times right now. Don't get me wrong. When the market gets on fire after a big bear market or whatever, the dang thing, you could pretty much throw a dart at the Wall Street Journal when it starts going.
Do well.
And you'll do fine. But it's for the times you don't. It's just like you don't buy insurance on your house when it doesn't. When the good thing, right? It's not. I mean, you're buying insurance, but you're planning for the worst. What if the worst happens? What insurance do you have on your stock portfolio?
It's like life insurance. No one wants to buy it because they don't want to think about dying.
No, I'm not going to die.
No, I don't need that. What do I need that for?
Forget that doctor say with the blood pressure, cholesterol.
I know, right?
That's all voodoo science.
That's right. And we all know about that height weight table.
Oh, my gosh.
That's messed up.
They told me I should weigh about 160 pounds, and I was like, well, that was the 7th grade.
I know, right?
What do you want now? This big head's because I'm around. I'm a full-figured face. That's
the brain. A lot of brain makes for a bigger head. That's right.
But so think about that. We can send you information on our managed program. Like I said, it's in every sector of the S&P 500, which there are 10 sectors. And they put an ETF so it's lower cost. Then you got fixed income, and they're diversified on the fixed income front as well. But they're giving you that right balance. It always rebalances automatically. They either could get it rebalanced weekly or monthly. So you never get one of those situations where you're overextended into one area. You're always going to be that balance. But it's tactically unconstrained. That's a fancy word for me, and they can be in cash if they want to. If you buy a normal managed account, not the one we're offering here, you buy a normal one, it's tactically constrained. In other words, you filled out some risk tolerance questionnaire, and it said you should be a 60-40.
And that's what they're going to do.
I don't care what happens if the bonds are getting killed and stocks are getting killed, you will always be a 60-40. With ours, it can be all cash, because if nothing's going up, we ain't going up in anything. And also, we don't charge you Woodward in cash, too. Well, that's our show, folks. I want to thank everybody for listening. Don't hesitate to call us if you'd like any information about anything you've heard on the show or like to talk about a free consultation. Our number is 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.